Chevron just out with quarterly numbers. Revenue came in quite a bit better than expected. The company did announce a number of different changes, including a big cut in capital spending. Joining us right now is Chevron CEO Michael Wirth. And Michael, thank you for being with us today.
You're welcome, Becky. It's good to be with you.
I don't even know on the bottom line how that $1.93 a share matches up to the street's estimates of 68 cents. I know there were a bunch of moving pieces, but I do know that revenue came in better than expected. $31.5 billion versus the $29.3 billion the street was looking for. But you are taking some pretty significant steps to say you're going to be cutting CapEx and making sure you're protecting the dividend. Why is that?
Well, Becky, first of all, I'd just like to say that our thoughts continue to be with those affected by this virus and also with all the workers out there on the front line, keeping people safe and provided for, including those in our company and in many, many others. We had a solid quarter in the first quarter, but the situation certainly is difficult in our industry for everyone. And so look, we're in a different place than many others. We were prepared to execute. Our financial priorities have not changed. The dividend remains strong and safe, and we know what to do, and we're doing it. And that includes taking some additional prudent actions to further reduce capital expenditures and operating expenditures in response to the environment that we see.
Hey, Michael, obviously in April, crude oil prices came under extreme pressure. I've never seen anything like it. Have you ever seen anything like that?
No, that certainly was a very challenging month, as I think we really have seen demand at places we've never seen before. And the market reflects that, and supply has been slower to respond to that. And so prices reflect the real dramatic impact of the slowdown and, in fact, shutdown of economies around the world as we fight the virus. And so pricing responded very quickly. And I think as we begin to see things move forward and economies begin to pick up again, demand will gradually return.
I mean, we're looking at the June contract for WTI trading above $18.80, and that is a long way back from where we saw the May contract as it was starting to expire and close out. What were you thinking as we watched the May contract actually go negative? People were paying people to take oil from them. What did that mean to you?
Well, we know that because demand is off so much, that production needs to find a place to be stored if it can't make its way into refineries, not into the marketplace. And in the financial markets, these contracts close each month, and there's an obligation to take product if you hold a contract. And without a place to physically store the oil, I think you had some people who were caught in a position where they couldn't actually accept delivery, and they had to get out of these positions and eventually ended up paying for that. Our company is a big player, obviously, in the physical markets, not so much in the paper markets. And so those two have become somewhat disconnected here with these unusual conditions. And so we watch that very closely because the physical market can price off of the paper market, but we're not actually a big player there. So certainly a never before seen set of circumstances, but it's reflective of the underlying state of supply and demand in the marketplace today.
You're one of several companies, I believe, that's leasing space in the nation's strategic petroleum reserve. Why are you doing that? What does that give you in terms of flexibility?
Well, it certainly gives us some operational flexibility as these markets try to find a bottom and recover. And producers are looking for places to temporarily store their oil. Normally, the government buys oil to put into the reserve. And in this case, because the money hadn't been appropriated, they chose to lease space out to a number of players. And as a normal operational matter, we have production, we have storage and transportation, and certainly refining and marketing. And so we have storage capacity along the value chain, and an opportunity here to take some storage for a period of time allows us the operational flexibility to manage the logistics in our business through this period.
Hey, Michael, the steps that you're taking today, including cutting CapEx, I guess, by another $2 billion down to $14 billion, Is that something you're doing because you have to, based on the moves we saw in the last month, which all came after the first quarter ended? Or is that something you're taking in case things get worse from here?
Well, we were prepared, and the playbook to respond to a situation like this in our industry isn't really a secret. What matters is how you execute it. And so we've already taken strong moves on capital spending, announcing today another $2 billion reduction. So that's 30% or $6 billion off of our original budget. We'll actually end the year at a spending rate that's about $8 billion below, so a 40% reduction. Stopped share buybacks of $5 billion per year. We announced operating expense reductions of $1 billion this year and another $1 billion next year. And we've actually been able to close almost $2 billion worth of asset sales even in this environment. So in a low price situation in a commodity business, revenues drop much faster than costs adjust. And so it's important to have a strong balance sheet, and it's important to be prepared to take the moves necessary to conserve cash and maintain the financial strength through this period of time. We came into this with the strongest balance sheet in our industry and have moved quickly and decisively to protect that balance sheet, which allows us to protect the dividend for our shareholders.
By cutting operational costs by $1 billion, what does that mean in terms of jobs? Will that impact people who are on the job today, or does that mean you won't be hiring people to do additional drilling that you may have planned before these changes took place?
Well, in the short term, what it means is we obviously reduce travel, we reduce a lot of discretionary spending, we reduce activity. So we have fewer rigs running and have constrained a lot of different activities. So third-party spend with suppliers is down significantly. Before this began, we actually had announced the intention to take steps to further improve returns and become more efficient. And some of that involves restructuring of our business and will involve changes in our workforce. So that work was important before we entered this period of time. This reminds us how important it is to always be efficient. And so as we move through this to the back half of this year, there is likely to be some impact to staffing levels and workforce, but that was work that had begun even before the coronavirus.
Michael, the Trump administration has said that Chevron has to wind down its operations in Venezuela by the beginning of December. I think you're the last ones who are still operating there from this country, at least. What does that mean for you?
Yeah, Venezuela has been under sanctions now for some time, the country and certain individuals. We've been in Venezuela for the better part of the last 100 years, and the Treasury Department has issued repeated 90-day licenses that allow us to remain in the country. We don't actually operate any assets in Venezuela. We're a partner in two operations that are operated by another company. And our people provide technical services. We support with engineering, maintenance, and that type of activity. And in the past had lifted crude oil in part to fund the operations of these two ventures. The licenses have gradually restrained the kinds of activities that we can do as a partner in these ventures. And the most recent license runs longer than 90 days. It goes out through December. And it asks us to wind down, or requires us to wind down, certain additional activities that we've been previously allowed to do. It doesn't actually require us to leave the country. It just restricts activity to a smaller set of the things that are required as part of this venture. So we intend to comply, obviously, with the requirements of the government, but we're not actually winding down and leaving the country. We're winding down certain activities and still able to pay our people, support communities in Venezuela, which are very, very important in a time like this, and hopefully preserve our position in these important businesses so that we can be prepared to go forward when the situation in the country improves.
Hey, Michael, as a global company, you've got a pretty good idea about how things are operating in different parts of the world. We're kind of waiting to see what happens as our country starts to open up again, potentially at least in some of the states, to get back to business. What have you seen in terms of demand from the rest of the world? We know that China's ahead of us, Europe's ahead of us, and I guess I just wonder, do you think we've seen the worst of it to this point? Do you think it's going to get easier? You're also monitoring shipments of oil from around the globe. What's your best take?
Yeah, certainly this quarter looks like in our industry we're seeing a bottom. And, demand for
this
for
quarter
jet
being
fuel,
second quarter.
This quarter being second quarter, that's correct. So first quarter, we were on a bit of a downward trajectory through the quarter, certainly accelerating as we went through the month of March. I think in April and May, we're finding a bottom in demand. Jet demand for aviation use is off 75 to 80% everywhere you look, some places even a little bit deeper than that. Gasoline demand plus or minus 50% off, and diesel about 25% off. Those numbers are relatively consistent in most regions around the world. What we're seeing here in the last few days, and called a week and a half, is things seem to have bottomed and leveled. And in certain areas, we've even seen a bit of an uptick off of these very, very low levels. So I think we're still in a place where governments are trying to understand how to allow their economies to resume. Everybody's at a different place. And plus or minus, I think, through this quarter, we're probably going to see things at a level space and beginning to return. Certainly the data would suggest we're beginning to see that. But it's going to be a very, very tough quarter.
Michael, thank you for your time. We really appreciate it. And thank you for coming on with us.
Becky, thank you. Always good to be with you.